Hello, everybody. This is Deep Macro's Future of Finance. I'm Jeffrey Young, the CEO of Deep Macro, and today I'm speaking with Michael Saylor, Chairman and CEO of MicroStrategy. Mr. Saylor is a technologist, entrepreneur, business executive, philanthropist, and best-selling author. He currently serves as Chairman of the Board of Directors and Chief Executive Officer of MicroStrategy Inc. Since co-founding the company at the age of 24, which was what, like 5 years ago, Michael? Mr. Saylor has built MicroStrategy into a global leader in business intelligence, mobile software, and cloud-based services. In 2012, he authored The Mobile Wave, How Mobile Intelligence Will Change Everything, which I agree with, which earned a spot on the New York Times bestsellers list. Mr. Saylor attended MIT, receiving an SB in Aeronautics and Astronautics and an SB in Science, Technology, and Society. In addition to that, he's all over the place these days. Michael, welcome, and thank you. And can you just take 5 minutes to explain what is crypto, what is Bitcoin, and what are you doing with it?
Sure. Thanks for having me, Jeff. So what is crypto? Well, crypto is a technique of creating decentralized networks where you don't have to trust any one central server. Bitcoin is the most successful of these crypto networks. Bitcoin is a crypto asset network. In essence, if I was designing virtual gold in cyberspace, I would design a software program that created 21 million gold coins, put them into cyberspace, and then I want to run them on a decentralized set of servers and scatter thousands and thousands of servers everywhere in the world, running with special purpose hardware such that network of decentralized servers kept track of the ownership of the 21 million virtual gold coins. So Bitcoin is that. In essence, it is a decentralized crypto asset network. What's its role? Well, its primary role today in the macroeconomic environment is it can serve as a network hosting digital gold and provide a store of value, a non-sovereign store of value that is global on an open digital monetary network. So what does that mean? Well, everything you ever wanted out of gold, if I want to bury $1 million for 100 years and keep it, even though currencies might collapse and companies might fail, the old idea was use gold. Well, the problem with that is that after 100 years, gold miners will have dug up a lot more gold. And so if I had 10% of the gold supply 100 years ago, I would have 1% of the gold supply 100 years later. And the second problem is maybe someone steals the gold from me because it's very physical. If you want to move $1 billion of gold, it's 30,000 pounds. It takes $5 million in 1,000 days and maybe a couple of 747s. On the other hand, Bitcoin would allow you to move $1 billion of Bitcoin from New York to Tokyo in an hour for $5. So Bitcoin, in essence, is 1 million times faster, 1 million times cheaper, and not only, and it's harder because you can't make any more of it. It's fixed at 21 million. So 100 years from now, there'll still be the 21 million. 1,000 years from now, there'll be the 21 million. So for the first time in human history, we have created, in essence, I'll call it a bank in cyberspace run by incorruptible software that offers a simple, safe, affordable savings account for everybody on earth that doesn't want to run their own hedge fund or can't run their own hedge fund. You can deposit $5 into Bitcoin, or you could deposit $5 billion into it. So imagine if I just created this bank in cyberspace and $21 million got deposited into it. There's 21 million coins. So the price of Bitcoin would be at about $1 a coin. When $21 billion got deposited into it, the price of Bitcoin goes up to $1,000 a coin. And as you deposit more money, the price of Bitcoin is, in essence, if you look at it, it's like the amount of money deposited in the bank in cyberspace divided by 21 million. It is literally a bank in cyberspace. Now, is it better than gold? Yeah, because it's harder and you can audit it every 10 minutes and you can take custody of it. You could put $1 billion of Bitcoin in your head You got to hold it in a hardware wallet. You can't haul $1 billion of gold through an airport. So you can take custody of your property. For the first time in human history, you could take custody of $1 billion or $10 billion worth of property and hold it in your hand or in your head. There's no other property. So it is the most powerful form of property, but it's also better for another reason. It's also programmable. So I can write a computer program that'll take that $1 billion and slice it up into 1,000 pieces, loan it out for 4 hours, fetch it back. I can cryptographically prove that I have it in a split second. So this is money I can hold in my head. I can move at the speed of light. I can put on a computer server, and 1 million computers can trade with each other. And so people that are enthusiastic about Bitcoin, they might like it because it's a better gold than gold and it's a store of value. But you might also like it because it's the basis of the 21st century fintech economy. You can build a better banking system and a better financial system on a digital asset like Bitcoin because it is 1 million times faster, smarter, stronger than the alternative. And that's the exciting thing right now in the world.
And a lot of those transactions that you mentioned would not require the traditional intermediaries. Obviously, there must be software, there must be people who write the software, there must be companies, but these are not the same sort of structures as we have right now involved in, transferring money across borders, which as a small company, we have a lot of problems with.
Yeah, and the real genius of Bitcoin is it's a decentralized peer-to-peer network, which means that one person in San Francisco can transfer to another entity anywhere else on Earth, and you don't have to go through a set of intermediaries. And as you know, if you have 3, 4, 5 intermediaries, each one layers on a 2-day delay or maybe a 2. If you wanted to do trading with 10,000 counterparties, you might have to go through a 2 or 3 month process in order to figure out each of them to be able to trust them. And so
correct.
The impedance and the friction in finance is 1,000 to 1 million times higher
than it should be, for sure. I agree with that. And like you say, I mean, I have a wallet, it's right here and it doesn't have $1 billion on it, but it is a very efficient way of holding, and I can understand that. But one thing I wanted to ask, you're talking about as an asset, as digital gold, as virtual gold, and a store of value. These are beginning to shade into, the idea of a currency. And I believe that you've kind of thought before and spoken about that, Bitcoin can be an asset. Others think of it as a currency. How do you think about it as a currency? And is there sort of an inevitable connection between being an asset and then becoming a currency?
Well, the textbook definition of money is a medium of exchange, a store of value, unit
Right.
of account. And a lot of people want something to do all those things. But I actually think that in the modern world, that is bifurcated. And Bitcoin is really a store of value and its property. Currency is the dollar and the euro. And the thing that makes something a store of value versus a currency is first and foremost, it's just the tax treatment of the asset class in the legal jurisdiction. So, for example, the IRS deems Bitcoin to be property, which means that if I give you Bitcoin at $1,000 a coin and you give it to someone else at $10,000 a coin a year later, then you owe a $9,000 a capital gain on $9,000. So the fact that you generate a taxable event every time you transfer this asset makes it property, and it makes it unsuited to be a currency. So as a practical matter, it used to be when, some people thought, well, maybe it'll be a currency. It won't be a currency in any legal jurisdiction or political jurisdiction where the country is functional, where the government is functional. In Europe and the US, you'll have the euros and the dollars that'll circulate. If you have a complete collapse of the government in some African country where the government can no longer create a currency, then what you'll probably see is that those jurisdictions adopt stable coins or dollars as the circulating currency, with the underlying asset being Bitcoin.
Kind of like an a digital dollarization that we have seen. We've seen dollarization in some of those situations before. Interesting. Then, in terms of adoption, the standard model for a lot of new products is you have early adopters, and then you have kind of medium adopters, and then the real pragmatists who just sort of use it after it really becomes very, very widespread. Where do you think we are in that process in terms of, let's stick with the asset side, not the currency side?
I think we're just finishing up year one of institutional adoption, and I guess we're in like the third inning
Okay.
of the baseball game.
Yep. I was going to
Like
avoid the innings, but since I think it's
something
a
like
good,
that.
yeah.
Um, I think that March of 2020 was an inflection point. The cost of capital and the monetary supply expansion tripled. So everybody on earth needed a store of value. It became very clear. I think that before March, it wasn't as clear. And I think from March until February 8th, you had early institutional adoption.
Hmm.
And companies like MicroStrategy and Square and Tesla were all part of that. But I think that after February 8th, when Tesla announced that they had added $1.5 billion of Bitcoin to their balance sheet, I think we moved into year two, or the next stage of institutional adoption, where this became Bitcoin in specific or particular became an item of discussion across mainstream media. And as you notice, the CEO of GM got asked, and the CFO of Twitter got asked, and the CEO of Uber got asked, and politicians started getting asked. And it came across the pages of the New York Times and the Wall Street Journal and the Irish Times and the Straits Times and Fortune and Forbes and all sorts of mainstream media. So I think we're kind of early on in year two, but now it's a topic of discussion.
Hmm.
I think that there'll be probably 3 years of intense, quote unquote, early adoption before we move to the next
And
stage.
I think that one of the things, at least people that I speak with, it's the volatility. Is it is lower vol really critical in the adoption process, or are we just going to have to live with this vol because it's new, people don't understand it, the
I think the
technology?
volatility is falling consistently.
Hmm.
I mean, it used to be in the first decade, the market was dominated by individual leverage traders looking to make a quick buck.
Right.
And then you had these parabolic runs, like goes up by a factor of 10 and it crashes by 80%.
Hmm.
But I think that changed after March of 2020. And then the institutional money started to come in and they crowded out all of these early, leverage traders. And in the newer market, the institutional buyers are buying in an allocation in lieu of gold. And your use case is, I'm just going to buy 100 million or 1 billion of it, and I'm going to hold it for a decade. And I'm not buying it with leverage, and I'm not buying it so much to flip it. Like they have a different time horizon. And if you look at the trading since March, it was more like it runs up 25%, or it runs up 40 or 50%, it comes down 25%. And it runs up 50%, it comes in 20%. And so the kind of volatility started looking like more common high growth big tech stock or something. And if you look at the volatility today and you compare the volatility of equities versus the volatility of sovereign debt versus the volatility of Bitcoin, they don't look that different, really. I mean, the other day, the 30-year treasury swaps, they jerked like 11, they were down. The yield on a 30-year treasury was off 6% in the day, or 5.5%. And it was the most volatile thing on my screen.
Right.
And so, I think that, first of all, if the asset's going to go up 198% a year on average for a decade, and that's the Bitcoin performance for the last 10 years, then incurring a bit of volatility to get 200% a year tax-free interest is a pretty good idea, because your alternative was gold, which is up 1.8% a year for a decade, or S&P, which is up 11% per year for a decade, or big tech via NASDAQ, which is up 16.7% a year for a decade, or long bonds like TLT, which is up 4.5% a year for a decade. So it's not even close. It's basically 20x better than equity and 100x better than gold. And volatility is a small price to pay. It turns out that the Sharpe ratio is better than any of those asset classes. So if you look at risk-adjusted returns, Bitcoin has by far the best risk-adjusted return in addition to the best risk returns.
Right. Okay.
And the story is the volatility is just going to continually decrease as the asset class gets bigger, as you would expect. Bitcoin's 922 billion, and gold's 10 trillion, and S&P's 32 trillion, and NASDAQ 17 trillion. So it doesn't take a rocket scientist to figure out that as the amount of monetary energy sitting in that network increases, the volatility will decrease. Likewise, probably the annual returns will probably decrease too, right?
Yeah, monetary energy in the network. I think there's an awful lot in there. And I wanted to, you mentioned taxation, you mentioned the public authorities. I want to kind of look at that. I mean, central banks, several central banks have talked about, some are even kind of launching plans to make quote unquote central bank digital currencies. These would be centralized, I assume, not decentralized.
Yeah.
Are they, what are they? They're not really like Bitcoin, I would imagine, that from the very get-go. And are they actually a threat rather than a sign that this is becoming adopted by the public sector?
It's not clear what they'll be. We'll have to wait and see. It'll probably take 4 years before we know that. But I think that we're looking at a duopoly system where you'll have asset. I mean, every investor is going to have assets. They're either going to be sitting in stocks, equity, bonds, gold, real estate, Bitcoin, and they're going to have some currency in their checking account, probably dollars. And as this grows, you know, those central digital currencies are really just dollars flowing over a digital network. I don't think they really change anything. It's kind of comparable to Square or PayPal plugging into Bitcoin. Mm-hmm. If I have the Square app, I can have $10,000 of Bitcoin in a savings account, and I can have a checking account.
Right.
And I can pay for my coffee with dollars.
Right.
And then over time, I will either sell the Bitcoin or I will borrow against it. Mm-hmm. Right. I think when the dust settles, the ideal situation is 1 billion people all holding Bitcoin as their store of value and then borrowing with a secured credit line in dollars and euros.
Right.
And then moving that over conventional payment rails. And those payment rails, you know, is it Visa? Is it MasterCard? In theory, a central digital bank digital currency could compete with Visa and MasterCard, right? Correct. But will MasterCard and Visa like that? Will the government do that? And
right.
Does it matter?
Yeah, right.
Like I can do things. I can pay a $20 bill with Apple Pay, and maybe it moves through the MasterCard system, or maybe I directly debit it with a CBDC.
Yep. I see. Yeah.
At the end of the day, it doesn't matter. I mean, you're looking at a bunch of currency circulating day to day, which is how you pay your bills. Right. And then you've got a chunk of your assets, your monetary energy sitting in a store of value, which you expect to appreciate over the long term.
Okay. And so on taxation, which you've mentioned as well, I mean, governments, I think what you're saying, if I get it correctly, is governments may actually tolerate this because as long as it's not a currency, governments actually get a lot of benefit from issuing currency through a seigniorage. It's a really important benefit that they like to monopolize.
Yeah.
But if we stick more on the asset side as the collateral for getting currency, they may sort of leave it alone more than is that possibly
Bitcoin
how the duopoly works out?
Look, Bitcoin is a competitor to gold.
Yeah, right.
Look, gold's $10 trillion.
Yeah.
There's $10 trillion worth of monetary energy in gold. Why wouldn't it all move to Bitcoin?
Right.
Because Bitcoin is a better gold than gold.
So Bitcoin
is a million times better than gold.
Right.
And so instead of thinking about it as a currency, think about it as an asset.
Mm-hmm.
And what it's really competing against is gold. And it's competing against, if you have money and it's competing against savings accounts, but who keeps their money in a savings account anymore?
Right.
I don't think anybody does. So really, people have pursued ETFs as their store of value, right? The average person would take the money they want to save for a long period of time, and they would buy the S&P index or buy the NASDAQ, or they try their hand at stock picking. If they're desperate, they start buying GameStop or they buy story stocks. Otherwise, they buy an index. Over the last 10 years, right? Long bonds yielded 4%, big tech yielded 16%, S&P yielded 11%. Those are all kind of quasi store of values. If the monetary inflation rate is 6%, which is what it was, you can see okay, buy tech, and that's a good idea. Keep your money in bonds. I don't know. Gold is only 1.8%. Now, over the last 12 months, Bitcoin's up 450% and gold's up 3.6%. Gold's a disaster. It's breaking down. It's being demonetized by Bitcoin. So the most obvious trade is sell all your gold and buy Bitcoin, because the only people buying gold are people that want to buy a non-sovereign store of value that's not tied to a forecast of fiat cash flows.
Correct.
That's what Bitcoin is. Mm-hmm. So, but the problem with buying gold is the gold miners are your enemy. The gold miners are destroying the value of the gold supply. Whereas when you buy Bitcoin, the Bitcoin miners are your friends. They're really just creating security on a network that's got fixed 21 million coins in the day. So gold doesn't work as a store of value. The S&P is up 25% over the last 12 months, and so is the money supply. Mm. So you can see that stock indexes, money supply, they're both tracking equally. Big tech, NASDAQ's up 48%. So it's staying ahead of the money supply. Long bonds, TLT, 20 to 30-year dated long bonds, are minus 11%. You're getting destroyed because you bought bonds at the top when interest rates, when the 10-year was 50 basis points and the 30-year swap was 72 basis points. Right. If you bought bonds then, well, now they're coming in. So that's not so good for you.
Sure. Okay.
So everybody's got to make that decision.
Okay.
What are you going to do?
Yeah. Let me also, following on the theme, another traditional inflation hedge is real estate. And I'm also thinking about kind of like business ideas. We could think of, is there a combination, say, between, say, Bitcoin and real estate? You mentioned 1 billion people holding Bitcoin in a wallet and moving back and forth between currency. Is it possible to use Bitcoin as kind of like a sort of really efficient securitization vehicle? In other words, if 100,000 people wanted to own a piece of the cash flows of Manhattan real estate, which looks cheap now, are these the sort of use cases in addition to a store of value that we're going to look forward to?
Here's how I think you should think of it. Commercial real estate, stocks, and bonds are all valued based upon the discounted value of their future cash flows. And so in an environment where the cost of capital or the risk-free cost of capital, which is the same as the monetary expansion rate or inflation rate, when that number is 15%, then all of those cash flows collapse and commercial real estate stocks and bonds aren't going to hold value. And so the only real estate that it makes sense to buy in an inflationary environment is trophy real estate that has a value and use to you personally. If you're going to buy your beachfront cottage, then yeah, because you can live in it for 30 years.
Because you like it.
And if I print 1 billion times more money, your beachfront cottage works. The problem with commercial real estate is there's a CPI cap in the lease. And so if you're buying real estate for its rents, you're going to get destroyed. Mm-hmm. Now, the way to think about Bitcoin is like Manhattan in cyberspace, constructed of 21 million city blocks. Each Bitcoin is a block. It's a place in cyberspace where 1 billion people will be living in 5 years, and where one day everybody on Earth is going to want to own property in cyberspace. You could have 7 billion people owning a little piece of this Manhattan in cyberspace. It'll go on for 1,000 years. there's no reason to ever impair the asset because there's no mayor, right? If there's property tax in California, you're moving your Bitcoin to Wyoming. If there's property tax in Wyoming, you move your Bitcoin to Switzerland. So really, the ultimate property is property that a billion people will live in cyberspace that you can then finance. So the best idea is buy $1 million worth of property in cyberspace. And when you want $50,000, borrow the $50,000 at a 3 or 5% loan, a securitized loan secured against the Bitcoin. And then if Bitcoin is appreciating in value at 20, 30% a year, or even 10 or even 5, then the loan to value is going to fall over time. Your debt to equity is going to fall, and you can roll over that loan and finance it forever without impairment. And of course, the highest value property would be property that you can get a bid on market to market every second of the day, everywhere on earth. So Bitcoin is the pristine collateral of the 21st century. It makes sense for everyone to use that as their primary collateral against their underlying loans. And it should obliterate the credit card business or the consumer loan business.
Is there anything specific on the corporate side, in terms of, holding Bitcoin? I think you've made the case, but is there anything specific to corporations? You're a large multinational company. I assume that you would imagine that it's a particularly good asset for a multinational.
Yeah, I think the most important point here is that conventional treasury strategies are broken. They're financially, intellectually, morally bankrupt. Like if I roll the clock back a decade, if the cost of capital was 7% and sovereign debt would yield me 3 or 4%, I could invest in that and get a negative real yield of 3%. And that means that over the course of 25 years or something, I lose half my purchasing power. So I'm holding my treasury for about a half-life of 20 to 25 years. When we got to the point where the cost of capital was 7% and the treasury yields are 0, now the half-life of your treasury is 10 years. But in March, the cost of capital went to 25% and treasuries and the yield went to 0. And now the negative real yield is 25%. And that means you're losing half your treasury in 3 years. And so at this point, you're looking at a negative real yield of 25%. And you got to plug in what you think will happen over the next decade. What's the money supply expansion rate? But if you plug in 15%, you can see that you can't keep up with the cost of capital. And if your choice is either you leverage up the company, short the dollar, and then you give all the capital back and you buy back your shares in order to leverage up your cash flows. And the problem with that is you're billions of dollars toward insolvency. You literally give up all your capital, you decapitalize, and then you take on billions in liabilities, running on a razor thin margin, trying to hold value in the stock. And that's what creates all this rippling chain of bankruptcies that you saw in the last decade, like Toys R Us and the like. The other alternative is you actually buy a hard, strong asset, which is Bitcoin. And instead of actually buying your stock back, you buy Bitcoin. And Bitcoin goes up 400% this year. If it goes up 200% a year, if you took $1 billion, you would end up with $10 billion in capital over the course of a few years, instead of giving $1 billion back to the shareholders and having a nickel in capital. Right. And that's really critical right now, because the surrogate for cost of capital, if you want to look at one, is the S&P 500 index, which is 25.4% in the last 12 months. If you're not getting a 25% yield as an investor, then anybody else could outdo you in 30 seconds by putting it into the SPY.
Right.
And so if you're a fiduciary and you're holding billions of dollars of somebody else's money and you're investing it at 0, right? That's a big problem. You're burning 25% a year of the capital, right? And there are problems, technical problems with corporate treasuries investing in equity because they're securities. Whereas Bitcoin is property, and it doesn't have that technical
Sure.
problem.
Okay.
It's beneficial to have property. Bitcoin can be a surrogate for a sovereign debt, whereas equity can't be.
And do you see, kind of again on the global side, do you see the adoption faster in certain parts of the world than, we've been speaking about mostly US now, but like I mean, certainly from my perspective, Asia seems to, be an early adopter. There are people who hold Bitcoin. The infrastructure is really developing, even in relatively small places like Taiwan. I mean, the infrastructure seems really good. Have you noticed on the corporate side a differential willingness to hold Bitcoin globally?
I think it's spreading everywhere in the
Mm,
world.
mm,
And it's spreading rapidly through private enterprises, but they
mhm,
don't announce publicly that they have it. So it's
mhm,
hard to track that at the corporate level.
mhm.
At the individual level, though, you can see it's spreading especially fast in countries where the currencies are collapsing,
Right.
like Venezuela and Argentina and Nigeria and places where they don't have a stable banking system and they don't have a stable currency. For them, it's a matter of life and
I
death.
agree, but that's one of the reasons I mentioned Taiwan, which is about as stable as you can get, low inflation, super conservative orthodox policy. But even in places like that, it almost seems like a barbell. You have the bad, the really troubled places, but also others. Let me just finally, what would be your worst nightmare dystopian scenario technologically? Because people have talked about 51% attacks. Is there a scenario where this all ends up in sort of a James Bond movie where somebody grabs control of the chain? Uh, and which has happened with some small ones, not Bitcoin, obviously, but with some smaller cryptos.
Well, I think that you can't dismiss the black swan because by definition, the black swan is the unknown unknown, and only an arrogant person would claim that they know everything in the universe. Um, but I think the Bitcoin is 1,000 times more secure than the next crypto asset network. And I think Bitcoin is 1,000 times more secure than every other digital network. I mean, you've seen uh, like Twitter got hacked last year. They took over the president of the United States Twitter account. So to the extent that I feel that all these concerns are really red herrings for an investor,
Mhm.
because if you're an investor, your choice is to invest in Google or Apple or Amazon, and those are a million times easier to hack,
Mhm.
right? I mean, all the non-decentralized, non-crypto networks actually have much simpler points of failure. We just saw with SolarWinds, a simple intern password
Yes.
hacked into the DoD system. So, you want to doctor strangelove scenarios like someone hacks into Twitter, has the president declare war on China, and someone hacks in the DoD system, and launches emails telling people to do something. Well, that's a million times easier than breaking Bitcoin,
Okay.
right? So I'm not really concerned about Bitcoin. I think that everything else on Earth is more at risk in the event of a malefactor, but we seem to be doing okay.
Okay. I'll write that into the script then. Michael, thanks so much. It was really fascinating. Fantastic. Thanks a lot.
Thanks for having me.
Okay, good.
The content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained in this material constitutes a solicitation, recommendation, endorsement, or offer by Deep Macro Incorporated or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction. All content is information of a general nature and does not address the circumstances of any particular individual or entity. None of the information constitutes professional and/or financial advice, nor does any of the information constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. There are risks associated with investing. Loss of principal is possible. Some high-risk investments may use leverage, which will accentuate gains and losses of securities or firms. Past investment performance is not a guarantee or predictor of future investment performance.